Good morning, ladies and gentlemen, and welcome to another special edition of Element's weekly trading activity recap, where we offer you insights, tips, common sense applications, and an all-around peek into what it is to live the life of a trader. All right, so let's go. I have a number of really good trades for you this week for you to gain some insight into my particular thinking process, but also the types of decision-making criteria that you also must develop in your own trading journey, in your own trading career, in order to put you on the path for consistent profitability and success in the markets. All right, so we're going to start this week once again with Cigna, closing off at the end of last week. I had a profitable trade in Cigna, and so I felt, seeing that I had a pretty good read on the stock, I would continue to follow it. And this is an important point that bears mentioning, which is there are so many assets, there are so many vehicles that can be traded, and you cannot possibly follow all of them. You cannot possibly be able to hope to come to accurate readings, accurate decision-making processes if you're trying to spread your attention between those innumerable and infinite amount of vehicles that you can trade. And so as a retail trader, best practice is that you focus on a few names that you follow day in, day out, so you understand the particular nuances of that stock. You understand the nuances of how the options market for that stock work. You understand the nuances. Is it volatile? Is it slow moving? Is it spiky? Is it a stock that likes to trend once it gets underway? So me continuing to stick with Cigna was actually reflective of my understanding of that principle. But understanding a principle and applying it consistently are two different things. And for one of the trades that I'm going to show you later on in the video, I did not apply this principle very well. But let's start with Cigna. So let's zoom out to a 10-day 1-hour chart so we can see exactly what was going on and what I was seeing in Cigna. So having traded Cigna last week, we can see it was holding this upper range after having been as low as around 176. It had a very strong bounce up and then began to make this holding pattern, this pattern of consolidation for about 4 or 5 days. And then it began to try to attempt a breakout at around the 192 level, which it did hold for some time, bounced around for a couple of days. And so when I zoom out to the longer term time frame, to the weekly, we can see that Cigna is actually trying to make a remount of its intermediate trend in order to try to affect a retest of its most recent highs at around 225. Bear in mind, it does have earnings coming up shortly. And so at the very least, I'm thinking, whilst it may not regain momentum, whilst it may not retest these highs before earnings, even if it were to try to attempt a move into this gap at around 205 and 210, I'd be very satisfied to get even 50 to 60% of that move. And so very early on in the week, on Monday to be precise, I was looking at Cigna, and it opened, had a very large range bar, which told me that possibly it was willing to move, it was willing to enter into price discovery mode in one direction or the other. And so on this pullback, on this candle right here, I entered some calls, long calls. We purchase long calls when we are expectant of a move up in the security. And so I purchased long calls anticipating that Cigna would begin to move up. However, the market does not always cooperate with us and do what we would like to do. And this is why we must have our risk management process and plan in place. So whilst it was consolidating all day, in the last hour, it had this dramatic drop out of nowhere, it seems, and then ended the day slightly lower with this ended the day slightly lower with this small attempt to rebound back into this range of consolidation. And so I was sitting on probably a small loss on Monday as Cigna fell to the low of its range for that day. On Tuesday, however, it opened up and opened up strong. Within the first half an hour, it had retraced almost completely that entire move yesterday in my direction. And as I held, I watched it continue to move up and up and up. And I was expecting it to test the 198 level. However, when I looked at what the market was doing on that day, it was range bound. It really couldn't seem to get much traction to the upside or much traction to the downside. And generally speaking, unless a stock is very, very, very strong, it will tend to gain most of its momentum from what the overall market is doing. And because the overall market was not performing strongly to the upside or strongly to the downside, the probability of breakouts, in my opinion, was diminished. And so I chose to sell on the break of the low of this candle here. I got in the trade for 320 and I got out of the trade for 450. So about a difference of $130 on each contract, and I had two contracts, so for a total of 260, which was not bad as a cash flow income generation, trade. So that was Cigna. I got out here. The market did begin to come in. It came back all the way down to test almost this high that it spiked into yesterday, the day before, and then began again to move upwards. Now, this is something that every trader experiences at some point. We love to be right. And so even when I have made a trade and I've come out of the trade with some significant profit based on the amount of money that I was risking on the trade, it's almost like I want to see my thesis validated. I want to see the stock go down after I have exited, And so sometimes when you see this and then it rebounds even higher than it was before, obviously, which means that if you had held, the trade would have been even more profitable. But the thing about it is we are finite. We do not know the future, and trading is not about predicting and accurately knowing the future. It is actually more and issue of money management and a robust risk management process that over the course of many trades, many iterations of trial and error, that you win, not more often, but you make more money on your winning trades than you lose on your losing trades. I'll say that again. Trading at the end of the day is not about being right. It is not about necessarily having more winning trades than more losing trades. It is about having a strong risk management process, a strong money management process, such that the magnitude of your profits that you gain from your winning trades are larger than the magnitude of your losses from your losing trades, right? Remember that. It's key. It really is. And probably I will do an entire video of its own on that. So Cigna again came up on Wednesday, tried to test this 198 area, was very quickly rejected, and began to consolidate. Now, had I not been watching other issues, I may have wanted to get back into the Cigna somewhere here in this consolidation, thinking that it's doing this nice little tight uptrend. The only next logical conclusion is breaking out. Unfortunately, it opened into this area on Thursday, immediately was rejected, bounced around, again opened up on Friday when the market was very strong, tested the high, immediately rejected, and back down into this consolidation area. So at this point, Cigna may need to retest the lows of this range at around 193, 192 in order to gain buyers from beneath, as opposed to gaining buyers in these new higher price consolidation areas. So Cigna is on watch for me going forward in this new week. Hopefully I'll be able to get a nice entry to anticipate further upward movement as it goes into earnings. And so the next trade that I have on, that I also entered on Monday of last week, the 14th of January, is a short call spread in SPX. So the spread that I entered was the 2590 2600 short call spread. So let's see where that is. It is the 2590 2600 call vertical. So what I was looking at was the market has been steadily grinding its way up, steadily grinding its way up. If I go back into a 10-day 1-hour chart, in this period, steadily grinding its way up, and the next resistance level was this 2600 round number, but it had tested it in attempting to break through that on Wednesday, on Thursday, on Friday, and could not. And so when I saw the market open on Monday, and it was also doing this very tight consolidation range, I knew usually that means at some point it is going to rally to the highs of the range and most likely be rejected, and it is also going to test the low of the range and be rejected down there as well, because this is a consolidation day. And so I waited, I was patient, waited all day for this opportunity, because it only came at around what time did I enter the trade? At 1:41. So literally with 2 hours, almost a little more than 2 hours and 20 minutes to go before the market was closing that day. And I chose to, of course, use the expiration, the SPX weekly options that were expiring that day, because the time decay would be working in the favor of my trade, especially at that late in the evening. Theta would be, provided that I got a move in my direction, theta would have been, a good boon. And so I entered that trade at 141. On this candle. So as the SPX moved up and came to test the top of this range here at around 25.88, I sold the 25.90 2600 call spread, anticipating that this highs of the range would hold, and it did. So for around 8 or 9 minutes, it tested this top and then came back down into the consolidation area, and I took profit in this candle as it came back down into the bottom of the consolidation area. So I entered that trade for $220 or $220 per contract. I had 2 contracts, so the overall credit that I received was $4.40. And then I sold or bought the cover for 80 cents. So more than a 60% profit at that point. I did expect that this low would hold, and that is why I did not leave the option to expire or wait for the option to expire, because sometimes, look what happened. Right after this downtrend, it immediately bounced right back up, looking to test the top of that range. Now, on some days, this may have been a trade to keep and hold on to, anticipating that it would not break up just as it did not this first time. But because the SPX in the market lately has been so volatile, large range bars, I did not trust in this environment after having made more than 60% on the trade to continue holding for 40% with the possibility of me breaking even if it came back to the top of the range, and or incurring losses if it broke out. And so I was happy to take 60%. There are going to be times that I may indeed hold, because every extra does count, but this market environment, I don't believe is the time to do that. As you can see, the next day, wham, opened and broke through this area of consolidation as if it was not there completely. So always have to be very mindful of that. The next trade that I entered to was Jan14th. I like the bottoming action that I saw in Jan14th. And so this tight consolidation action here got me interested, looking at very, very, very tight consolidation, an attempt to break out to the highs of the consolidation, a rejection, a retest to the middle of the consolidation, and continued consolidation. Now, price has very particular patterns, and one of the principles or patterns of price is that after consolidation comes expansion. After price narrows, it will expand. And so, generally speaking, I like to enter trades when price is congested, when price is contracting, in anticipation that price is then going to once again go into expansion in the direction that I anticipate. And so I entered Jan14th at when did I enter this? I entered it on Wednesday very early in the morning, just before, at about 10:51. So let's narrow down to that side. So yeah, where are we? Wednesday. Yep. So just around this area, I entered the 128 calls on Johnson & Johnson, anticipating that it would retest the highs of days and break out into a volume pocket above. This did not work out well immediately because it was rejected from the high of this tight consolidation, continued to consolidate, and actually fell into the evening. But again, based on the number of contracts and money that I had at risk, I was comfortable holding Johnson & Johnson to give it some time to perhaps retest the lows of the range, gain buyers from below, and then move into price discovery mode to the upside. And so I actually was very pleased. The next morning, it opened up, quickly fell down to retest the lows, came back up to retest the highs of this former range. Given what the market again was doing on Wednesday, I was not convinced that it would break out at the top of this range. And an opportunity to sell at around 129, I took that opportunity here on this falling candle to get out of the trade, just for a little more than $100 in profit. Not typically what I settle for, but because of the way the market was looking, we were heading into resistance. I did not want to turn this into a losing trade, and so I preferred to get out for 100 profit as opposed to 0 profit or a small loss if Johnson & Johnson then retraced all the way back down to the lows of the day. And again, I mentioned earlier in the video, it's not about being right, but it's about having a strong risk management process to ensure that over the course of time, habitually through the course of many, many trades, I break even and or make more on my winning trades versus what I lose on my losing trades. So the next morning when Johnson & Johnson opened higher above this consolidation area and then ran right into its next area of overhead resistance, my calls doubled at that point if I had held. So sometimes it's difficult. This is one of the emotional areas of trading that is difficult to deal with. Knowing when to hold, when to exit, when to be patient with your trades, and when not to be. And it is a continual process of refinement, and no trader is perfect at it. We're all working at it. 10, 15, 20 years, 5 years, 6 months, 2 years, no matter how long you've been in the market, entries and exits is always going to be a point of refinement that needs further refinement. And eventually you develop a pattern and a feel for things, so much so that when these sorts of things happen, you don't get too moved or upset by it, because you understand the penchant or habit for taking profit when you do not feel like the market is being supportive of your position in the long run will outweigh the few times where the market then escapes and goes without you. All right, so keep that in mind, guys. I also had a trade in booking. This trade took place on Wednesday as well. And the reason why I took this trade was I was looking at this area of consolidation between 1680 and 1700. Bottom of the range, top of the range. Bottom of the range, top of the range. Bottom of the range, top of the range. Now, of course, I entered this trade on Wednesday, so I did not see all of this. But what I expected, seeing this area of tight consolidation, I said, you know what? If I get a dip down into 1680, I would love to be able to sell some puts in anticipation of a rebound from this low of the range back into the highs. And so I was stalking this trade all day, all day, all day. Price line was, booking, which price line was formerly known as, held a very, very, very tight range all day. 5 to 10 points, 5 to 10 points, 5 to 10 points. But at the end of the day, it had a little bit of a mini sell-off. And I actually had a trade entered in for a really healthy credit of $3.20 on a 7.5 strike wide put spread. And so I actually got an alert on my phone. I wasn't even at my computer when this happened. I got an alert on my phone to say that my trade had triggered, as very fortunately booking came down to test that 1680 level once again, and I was filled actually on this candle right here as it broke through the 1680 and came back up just slightly. And so there are times that these sorts of things happen, that your stock that is showing relative strength has a sudden quick decline with the overall market. And so you should always be mindful of the stock's ability to do that. And so as I anticipated and expected, the next morning, booking tested that prior support that it had tested all week, found buyers, and simply zoomed all the way up. And so I was able to, because I saw that it was trending, it was very strong that day, I said to myself, you know what, I am going to take profit on this trade because I was in a Friday expiration, so those options were expiring the next day. But often in my experience, sometimes you may be 80%, 90% up on a trade, and you have no idea or expectation that some news is going to come out overnight that is going to move the stock in exactly the opposite direction and make you lose all the profit that you had in the trade, and or have you incur a loss. So what I've done is I've decided, for me, I would rather pay my broker the commission fees, the $10 or $15, to close the trade here in order to bank 80 or 90% profit on my trade, versus waiting until the next day when a whole new set of variables and criteria can be at play that are outside of my control. And so what I did was I closed the trade down in the very last, in the last 3 seconds of the trading day. I was trying for a fill for about a minute before I actually got filled at a higher price than I wanted, but I got the fill and I got out of the trade. I got into the trade for $320 on only one contract, so $320, and I got out of the trade for 37 cents or $37 on that one contract. So I made just shy of $280, $285 on that trade, commissions included. Lastly, we're going to take a look at Tesla. Now, take this as an example of perhaps what not to do, but funny enough, we often learn more from what not to do sometimes than what to do. And so overnight, Tesla had some bad news coming out of Elon Musk reporting that they're going to cut jobs and things of that nature. And so Tesla opened down, but when I was looking at let me show you what I was looking at in particular. When I was looking at the overnight and pre-market trading, I saw, of course, this big drop, but this low here at around 318, and then a slight recovery into 328. My thesis was, okay, I am not going to look for a bounce before anywhere before 318. It must test that overnight low for me to have confidence in a thesis in terms of selling puts as a result of the increased implied volatility because of this large down move. I wanted to see price stabilize or at least react. I wanted to see how price reacted around here to give me confidence in my thesis. And so when the market opened, and let's just take off that extended hours, and then we're going to go in. When the market opened up at around 323, had a push, rejected. I expected this flush down into 318 because that was the pre-market low. So at this candle here, when we flushed through and held 316 and bounced, I sold the 317 one contract of the 317 and a half 310 put spread, expecting that price would consolidate around this area and then at some point in the day begin to push up to test at least the 322 area, at which point I would have been very happy to exit the trade for a partial profit. However, that did not go as planned. It did bounce, but this was the extent of the bounce and came back down and broke down through this low, at which I added more contracts, but at a lower strike. So I sold the 315, 307 and a half put spread, anticipating that this 315 level would hold, would be the base of the holding pattern throughout the day. And at one point that thesis seemed to be correct, because after it broke down through 315 to as low as 312, it did come back up and was using that 315 level to consolidate around. And I anticipated that the longer it stayed here, I had a nice healthy credit. That credit would whittle away as time went on, and I would see even a slight bounce, even into 318 or 320, to take the trade out for a partial win. However, that did not happen. And in fact, it began to toy with the lows of the range, of that 315 range, broke down through 315, retested the 312 low, and just washed and flushed out for the rest of the day. And so I was scrambling to exit my position. I eventually exited the position, I believe, at around 3, at this little area right here, for a significant loss. I think I lost 300 per contract, which would total 900 over the 3 contracts that I sold. And what I did was I then rolled my 317 and a half 310 put spread on the lows of the day around here. I rolled that to a further expiration, anticipating that at some point Tesla will bounce, and when it does bounce, I will get out of that trade, hopefully for a scratch and or a slight profit. So now this leads me back to something that I mentioned earlier on in the video about sticking with the things that you followed, sticking with the things that you've observed, sticking with the things that you have observed the nuances about. Because I have not traded Tesla for a very long while. It was only because of the very large price move that caught my attention and shifted my focus from things that I was concentrating on all in the week to try to make a quick profit in Tesla to end my week very nicely. Up until that point, I was up almost $800 or $900 for the week, and that then was completely wiped with this one trade, with this one losing trade in Tesla. And so this is one of those things that as a trader we must try not to repeat, or have a system and a strict adherence to your system not to have happen, or to minimize the occurrences of things like this, because sometimes you are going to make mistakes. You're human. However, if you focus on the things that you are and have been trading, you are more likely to make better decisions, as opposed to something that you're not sure what the most recent nuances of the stock movement has been like. And so Tesla took me to the woodshed on Friday, and in fact, to illustrate even what I'm referring to even more, remember my last trade in Booking. I was following Booking for quite some time. I had a nice trade as it moved off the lows down here and came up. Remember, I was expecting this move up. Now, knowing Booking, I knew at some point it would hit a level of resistance and I'd have been able to sell a short call spread. I was actually looking at this trade and I was trying to get a fill up here for the 1775, 1782 and a half call spread, short call spread. And I wasn't able to get a fill for the price that I wanted. And then soon after, the price collapsed. And the thing about Booking is that the option market is sometimes so wide, any little price move in the direction away from you're looking to get an optimal fill in, it's very difficult to get a fill for a price that will protect you from an adverse move, or when price moves against you in the opposite direction. And so when I couldn't get a fill here, I then turned my attention back to Tesla, which was crashing or dilly-dallying at around that point. And because my focus was split, I was not concentrating, I missed this really nice opportunity for a nice credit up here on this retest at around 1775, and Booking just meandered downwards and never made an attempt to come back up into this range for the entire day. So this would have been a really nice, fairly easy trade to hold on to. So instead of a nice winner here in Booking, which I was following all week, I had a loss in Tesla. And so for you young traders, intermediate traders, and experienced alike, more often than not, stick with the things that you have had a lot of time to observe, a lot of time to test yourself, a lot of time to feel confident with the price action, because your decision making is more likely to be of higher quality than something that you have not. And so I took the loss in Tesla. I chalked it up to a bit of impatience and indiscipline, and I am going to sit down, have a think, do some journaling, and come back bigger and better to face the market next week with a revised process to help me deal with that particular shortcoming in my own trading. Again, I want to thank you guys for joining me for this week's trading activity recap. I really enjoy sharing my thoughts, my thought process, and going in depth into what is going on, not only in particular issues, but also in the overall market. So hopefully you guys can gain some insight into your own trading, the things that, the variables and the criteria that are necessary to come to sound decision making. So again, in trading as in life, this is Island Mint, sophistication in thought, but always simplicity in execution. Thank you guys. I'll see you next week.